Okay, as promised, we've got to check in with the bond market now. Jim Stening is the Managing Director of FIIG Securities. He joins us now with the latest. Jim, good to have you on board. Thank you. We have talked a lot about the Fed Reserve this week, given we had the decision, and then we had some inflation numbers today. Yep. I support the decision, I suppose, in some ways, that the Fed Reserve is keeping rates low for an extended period. The market's kind of jittery. They want something to change in that statement, and it's just not happening. No, it's not, is it? It seems to build to a bit of a crescendo before this, and then we get the same statement. But and then we say, oh, as expected. As expected, yeah. I think what they're doing, though, they are flagging that all these other emergency levers are being shut down. I think monetary policy is probably the last thing that they'll adjust, and you know, from their perspective, I suppose if they do initiate a tightening cycle, what markets tend to do is build in the extent of that cycle. So that would fundamentally have a big impact on markets if they did flag that. So we'd probably see longer term rates move up sharply. What we've seen recently is longer term rates, long bonds, or what the Fed or what the US government borrows at, those rates are actually starting to come down. So this stance is actually, you know, notwithstanding the supply, actually meaning a lower cost of funds is being enabled for things like home loans and things like that off the long term fixed rates. So there seems to be a fair bit of buy-in from the market that inflation will stay low, and that this is a strategy that can be sustained for some time to come. So it'll be interesting to watch those very long-term rates in the US because that does indicate that there's confidence about inflation. It's interesting, in that statement that we had come through, they did seem to leave the door open for a lot of possibilities still. And one guest, and I keep coming back to it just because I think it's an interesting point, China America Capital's Tim Mulholland, we speak to him every Wednesday, he was saying, you know, the program of buying the mortgage-backed securities coming to an end in March. He says he doesn't reckon it's going to happen because they've left that statement in there, you know, depending on the conditions and if we see that is fit at the time. He said he doesn't think they're going to do that. They're the only buyer in the market at the moment. The economic conditions aren't that good. Maybe we'll just hear in a month that they decided not to end that program. What do you think of that? Is that a possibility? I don't necessarily agree with that. That's a possibility. And the way the Fed, or the way central banks always talk, you know, there's always ambiguity there. I mean, they do have professed to be transparent, but yeah, they do need to maintain their options, I suppose. I mean, you know, it's interesting. We've seen in Japan where there's massive threats of deflation or deflation emerging, how they've started to reinvigorate some stimulus measures and things like that. So, I mean, that's something I suppose the Fed would like to avoid if at all possible. Okay, so ultimately rates are headed up, but there's a lot of things happening on the sidelines as well, various programs ending, but that's right. A lot of people would say maybe not even until November, December, an actual rate rise. That's what we're hearing. I mean, it'll probably happen before then because you know, we're starting to see the recovery. These measures are being removed. I'd expect definitely by then. Okay. The RBA also yesterday, we heard that they're actually keen to get more regular updates on inflation here in Australia. That's right. Do you think that would be helpful? What does it say about the RBA and what it's trying to gauge here? Yeah, well, look, without doubt, I mean, this is the real focus, the key focus, the key statistics. I mean, their charter is to keep inflation within 2 to 3%. But doesn't it encourage a short-term view if you have a month-to-month and then you're making policy based on that? There is that, but what we've got at the moment is we've got a quarterly statement. So really, that's you know, that's not necessarily reflective of the most recent data, if you like. And also we've got these other measures, the trim mean and these underlying, and if we can clarify those statistics and issue them more on a regular basis or more frequently, I think that can only lead to better management. I think it's a really good thing, and it's a good way that other market participants, investors in particular, can monitor it for themselves. I'm quite a conservative person, so in my mind I say, look, we've come through the crisis and obviously the Reserve Bank's done very well, steered us through. Why do you want to change it now? Like, it's kind of working. Why try and fix it? Well, I guess so. I mean, I think that's my conservative point of view. Well, maybe you're right, but I think you know, things seem to change. I mean, different weightings in the CPI need to be changed more frequently to actually reflect
what is relevant to the CPI reading, and I think that it's healthy to review these things on a regular basis.
Sure. Can I ask you about more broadly the bond market? What you're seeing in terms of new issues at the moment? What's happening?
Sure. Well, what we're seeing, we're coming up to the end of March, which is when the government has said that they won't allow people to access the government guarantee, or sorry, I beg your pardon, for ADIs or banks to access the government guarantee. So what we're seeing is a few of the smaller players starting to or taking advantage of that before that time runs out. So they're stocking up the pantry with cash. Obviously, the larger banks have the complete flexibility in that they can issue considerable sums all over the world without that guarantee now. So, yeah, we'll probably see a few more of those towards the end of the month.
Okay, and there was a particularly large offshore raising from Telstra, and that seemed to actually support the Telstra share price in many ways.
That's right.
What does it reflect about the local market? And I think we spoke a little bit about this with Wesfarmers as well.
I think this is a fairly open and shut case. I think this is not really something that the local market would swallow easily, and I think from the issuer's perspective, you know, things like execution risk and tenor played an important part in this decision. So, you know, it's a large deal. It's a 10-year deal. You know, it does show that there are some structural issues with our debt capital market. Outside the top end of town players, the big fund managers and investors, there's very few other investors. So that's really something that's being addressed at the moment, and I think it's something that will develop over time. The other thing is I think that smaller issuers or you know, issuers absent the likes of the large issuers like Telstra can certainly tap the local market, and you know, those government guaranteed issues are, for example, a small and easily placed shorter tenor.
Do you think it said that Telstra issue? Do you think it said anything about the confidence of the European bond market or bond investors as opposed to the Australian, the local market, in terms of their confidence in Telstra?
Yeah, their confidence in Telstra, their confidence in rating agencies, I suppose, but also the way that they behave. Europeans are, I suppose, the opposite to Australians in that the majority of their investments or their portfolio is allocated to fixed income. Oh, okay. So they're very comfortable investing in corporate bonds and buying bonds. You know, it's a very, very sophisticated debt capital market.
Okay. And can we ask you just very quickly about the big four banks as well? Term deposits, we're seeing some of those rates come down, which obviously savers are going to be worried about that. What does it say about the strategy at the moment for the banks?
Well, yeah, I mean, look, perhaps they, you know, they're pausing. I tend to think it's a bit of we're in the eye of the storm. I think competition will be well and truly reinvigorated over coming months. I think as investors go, there's still very attractive government guaranteed rates out there. There's also other banks, other ADIs and other credit unions and building societies that offer extremely competitive rates. So if you search around, you can still get some really good deals.
But you reckon don't look in something right now? You think there might be better rates to come?
Well,
if you're a saver, you want to put money somewhere?
If you're talking about the big four, I think that's the case. But I think that there are still opportunities to lock in really good long-term rates. You know, bearing in mind that we haven't seen these type of term deposit rates over and above the benchmark rates, well, as long as I can remember.
Is this just a small window of opportunity, or do you reckon we're good for a while?
I think it's going to stay around for a while. It may not be as elevated as this, but what will help is underlying rates moving up as well.
Okay, I'm getting in trouble. I know we have to wrap up. Thank you very much, Jim. Great to chat to you as always. Jim Stening there from FIIG Securities. Yes, we have to go over to the Australian too. We've had this